off here. So today we're going to do the second part of tax analysis. Specifically, we're going to be talking more about the personal side. We did business last time. And so Tom's going to walk us through for our integrity capital education, just understanding how to do cash flow for the personal side of the tax return. So Tom, take it away.
Sure. Let me grab the screen share here. All right. All right. So this is our business cash flow that we went over last week. Can you guys see that? All right. Did it show up on your side?
I see it. Yeah.
Okay,
I see
good.
it.
Cool. All right. So, obviously got to cash flow the business side, and then we also have to cash flow the personal side. Some of these lines, they'll be flowing over from, information we gathered on the business side. Personal tax returns are going to be the 1040. There's going to be schedules involved. On the personal cash flow side, the real schedules that we're really only going to include on that are going to be the Schedule E. If you have a client with Schedule C income, you're going to cash flow it as a business. So you'll really be plugging that into a business cash flow side. And there's other schedules included, but normally not reoccurring income. Things like capital gains, that wouldn't be included. There's a Schedule F for farm income. I think I've only ever seen that once in my whole entire life because it's just not used very often. But you might see it that's going to be cash flowed as a business though, so that's going to flow to your business tax returns. So personal side, basically, we want to make sure that they are personally financially sound, and it's not a case where they're gonna either the business is supporting them too much and they're gonna undermine the cash flow on the business side with personal expenses. And the first line that we're going to be looking at and on this is going to be wage income. And it's important on the personal income side, income received on tax returns are from both tax filers. So make sure your tax filer is your guarantor. If you have a situation where you've got, the husband is going out to secure a loan for his business, and the wife doesn't want anything to do with it, but she's successful financially and has a job that has a good chunk of income. Make sure you're not just taking that income line off of the 1040 and including it in there unless she is also going to be a guarantor on the loan. So if we share my screen here to so this line here, box 1, that's everybody's income that's filing on the tax return. So make sure that if it's husband and wife, that wife is going to be a guarantor. Otherwise, you could look at it out the gate and be like, this is fantastic, but wife doesn't want to guarantee. It's not gonna help. So something to consider. That's not always said for debts though. So that's where that can, if you've got a husband and wife that have all joint debts are going to be factored into it. So just keep that in mind, later on. So first line, we need to make sure we're capturing wages and salaries off of here. Have the individual W-2s if you have two filers, or make sure you understand that only one person has the wage income. The next is going to be retirement income and disability. The way I always do that is I just lump it together on my form. This comes from multiple sources on the tax returns. You can see it could be IRA distributions, pensions, annuities, Social Security, and the annuity line on the tax returns. It could be something where it's a disability. It could be some sort of insurance award. It could be anything, just any sort of structured payment, and that reflects on the tax returns in this section here. We've got IRA distributions, pension annuities, Social Security benefits. The other thing that's important to look for over here is the taxable amount. If you have somebody who's doing a Social Security benefit, distribution of 20,000 and the full 20,000 is taxable, they might not be in a spot where they're, of age or able to pull out their Social Security. It might not be an ongoing income source. That's something that you want to look at and consider, find out about that. Same with IRA, pension annuity, those can be taxable. It's, each of those is a little different. So just make sure that you're looking at it to identify, if Social Security is being received and it's all taxable, and they're, just double check the age, make sure they're able, they are actually of age to receive that IRAs, 401k sort of distributions. Social Security benefits can be received for disability. It might be a short-term benefit, something like that. So just watch out for that sort of stuff. And then again, also make sure that individual receiving the income is on your application or going to be a guarantor on the loan. The one type of income that I had on listed, disability, that does not always get reported on a tax return. So if if it's something that a client brings up that they have disability income, just make sure that you are capturing it. It can offset things on the cash flow. I've had clients in the past that receive disability income that it doesn't reflect on the tax returns, and it does make a difference. It's it's decent source of income. We're looking at personal debts here, so we think of business debts and business income, large amounts. A personal disability income, obviously it's not going to compare to the full business income, but we're just looking for debts to offset personal debts. So a small amount of income is going to make a difference on something like this. The next thing that we need to capture on our list here is going to be distributions. And before I go ahead, any questions, or are you guys following with this?
Yeah.
Yes.
Good.
Yes.
Okay.
Mhm.
Cool. The next line here, distributions from K1. So these two obviously adding together, adding into the cash flow, because they are sources of income, they are cash flow. The next one, distribution from K1s. This does not necessarily show on the tax returns. This is from the K1. So from the the review that we did last week, we're looking for those distributions that we're reducing as income on the business side, because even though it doesn't get reported as a on the tax returns, it doesn't show on like the front page of a 1065 as a business expense. It is ultimately cash flow or money coming out of the business and going somewhere else, and it's going to our client or our guarantor. So we want to cover that, and we add that in here as a source of cash flow, distributions from K1s. Make sure you're not just taking all the distributions from the entity. Make sure you are taking the distributions that are going to the individual. So if you've got, father and son run a business, and there's a total of 100,000 in distributions, make sure you're not hitting them both with or giving them both benefit of 100,000 in distributions. Make sure you're taking it off the K1 and giving them their individual distributions. And the other part to look for, that normally the total tax payments, the reason for the distributions is normally for the individual to pay their tax on the business income. So these first three we're adding together. Total tax payments is going to be what we're going to subtract from that, and that we get off of the 1040. So if we go back to the 1040 and we go to page 2, we're going to look at total. We're going to look for total tax. This is the total tax owed. So we're looking at gross income. so gross wages and disability received, and then distributions received from the K1s, and then we're going to subtract their tax liability from that. So that is where we're going to get their personal their personal cash flow for the most part on clients. Go back to my form here. So we'll be using wage income, disability, distributions from K1s, and then subtract the total tax payment because they have to pay that. So the next thing we might run into is Schedule E rental income. These are going to be personal properties, personal rental properties. You might see clients have properties owned in a business or an LLC that are rental properties, and they're filed on like a 1065. Those are not properties we'd want to include in here. This is just going to be properties that they include on their Schedule E, like their rental house, that they single family residence rental house that they write off on their taxes. That is going to be found on a Schedule E, which Schedule E, that's a bit smaller for you guys. It's on the first page of the Schedule E. It's not going to be, this is the second page of the Schedule E where the K1 income gets reported. We want to make sure, look on their first page of their Schedule E and see what's going on there. Because if we look on the tax turns, there it's going to show Schedule E income. We just want to make sure that we're getting it from just here. Oh, now I've closed my window. Hang on a second. Here we go. We want to make sure that we're taking it from here. So we're just capturing just the rental income. And what we want to do is we want to take the top lines are going to be rents received. We want to take it from the bottom after all the expenses. So we can see total expenses. And then we want to take the actual rent received, which a lot of cases this will be a loss. Because just typically when people file rental properties, they tend to add a lot of expenses in there to show it as a loss. So this might be a negative number. Then this is kind of similar to what we were looking at on business tax turns. We want to be taking depreciation or depletion and adding that back in. I've seen in the past, other expenses listed with amortized amortization for an expense on a rental property. It does not happen very often, but it's good to check your other expenses and just make sure it's not in there, or that for some reason they did not list the depreciation under other expenses. I've seen that too. So you'll see other and you'll see listed here. It might say statement, see statement, similar to a business tax turn if there's other expenses, and you're going to have to scroll through the taxes to find the statement. So it is worth checking that other statement. But for the most part, we're just going to be adding back in depreciation. Again, that's it's just a loss of value. It's not an actual monetary loss. And then the other thing we're going to add back in is the mortgage interest. So just similar to a business expense, business cash flow, we're adding back in that mortgage expense because the interest is deducted, the principal is not. So we want to hit them for the full payment. So we're adding in the interest so we can get the full payment on the actual cash flow. So if we go back to here, we can see line for depreciation. So rental income or loss, add back in depreciation, add back in mortgage interest, and then that's going to give us the total cash flow for that individual before we start adding the debts back in. Debts for the individual, ideally we'd pull it from a credit report, but we don't pull credit. So we're going to be looking off of their personal financial statement. That's why it's key to getting a good, solid personal financial statement that's well filled out and includes everything. The client's only going to be doing them themselves a disservice if they complete that statement and they decide that, oops, I forgot to add my, vacation home mortgage on there and whatnot. It's just really gonna, throw the cash flow for a loop. So we want to make sure that we have an understanding of what their revolving payments are. These are credit cards. Anything that's not secured by a property, revolving debts, credit cards, or lines of credit, unsecured. Revolving debts and installment loans are separate on here, because installment loans, we can, for most lenders, we'll remove an installment loan payment that has less than 10 payments. Not always, but if somebody has auto loans that are being paid off in short time frame, just take note of that. Don't include them. Typically, it's anything less than 10 payments they'll remove. And we want to keep those separate also, because if at the end of the day we're looking and we're seeing installment loans are something that's kind of blowing the budget for them, most lenders, if we have them go and pay off an installment loan, something like that, it speaks more to keeping the cash flow in line, than if they're paying off revolving debt. If it's something that's tight on the numbers, because revolving debt, they can just rack up credit cards again. So, and so just something to note: installment debts, keep it separate from revolving, and keep anything with less than 10 payments removed from it. But make sure the lender is aware when you're discussing cash flow, that's the way you're looking at it. Next line here, we want to have rental properties, principal and interest payments, because we are already accounting for property taxes and insurance from the Schedule E. So we just want to hit them for principal and interest payments annually. The next line here, primary mortgage, principal, interest, taxes, and insurance, because none of those are accounted for on the tax return. So we want to annualize that. Last thing we're going to look at is living expense. This is really kind of a catch-all, and in a way a stress tester. So for example, SBA lenders will do living expenses, based on, we've seen on there's a living expense form that some of them put out, and they will literally take every item off of there and just throw it in. We've had in the past clients that put down, just shot in the dark numbers, and they decided they paid $500 a month on clothing, which I don't know if people do that. That sounds like a lot. I guess people do, but it kind of blew the budget, because it's just an automatic $500 a month payment, that just gets dumped into it. So, if you're doing SBA loans, make sure you understand your client's living expenses. If they fill out the living expense form, make sure that you're double checking it. If sometimes I've seen lenders do it for based on household, number of people in the household. They'll do a flat amount per family member. They'll do a percentage of the wage income. So it's something you'll want to check with your lender, and if you've got a really tight personal cash flow, just check with them and find out, hey, how are you guys going to stress test this? Plug that into your living expense column, and then you'll have your expenses for the household. And same, basically at the end, we're going to be taking our personal income and our personal debt, or cash flow and debt, and we're going to be doing a personal debt service ratio coverage. Now, ultimately, it's going to be looked at on a global level. So you're going to be taking your personal cash flow and your business cash flow, and your personal debts and your business debts, and looking at them on what the global, adding them together and doing that service ratio calculation. You're going to be looking at a global level, but you need to look at this and understand it, because you could have a business that cash flows very well, and a person's personal debts or lifestyle that just tanks it. We've had businesses in the past that were successful and on their own would qualify easily for a refinance, but the client's mortgage payment, being close to $10,000 a month, just completely blew the budget for the whole thing. And you need to be able to identify that, so you can talk to your client and let them know, hey, this is, this is why we can't proceed now, but if this is corrected on the personal side, it gives us an opportunity to get this done. You don't want to just, look at all the numbers as a whole. You want to look at the individual ratios, but understand it's the combined ratio, the global cash flow is what's going to get the deal done in the end. I don't know if you guys have any questions, comments, or anything like that I could add to on that.
No, I think this is really good because, like I said, it's important to be able to understand how to do business tax analysis plus to do the personal tax analysis, because that global picture really is a telltale. I mean, there might be times where the business doesn't, but the personal can service the data, and sometimes lenders will
Yeah.
make exceptions for that, and then
That's true.
vice versa, so if they, but so I think it's just super important to be able to understand it. I think this is really helpful to give a very clear step-by-step way to do it that's simple but profound. And so great job on communicating it. So that's what I have to say.
Thank you. Yeah, and I'll get this form sent over to you guys so you can make use of it and use it for your cash flowing needs.
That'll be great. Well, terrific. That is the education for today for personal tax analysis.